So if you own a cell phone with internet, watch TV, or had contact with anybody on planet Earth over the last week, you've probably talked about Trump's unveiled tariffs and the subsequent market volatility. So how does this impact you and what can you do? Hi, my name is Will Hubbard. I'm the founder and portfolio manager for Cirrus Capital. We're a sophisticated, not complicated investment firm. So welcome to our thoughts on what's happening. President Trump's announcement of new reciprocal tariffs on April 2nd has triggered significant market reactions. These measures, which set rates up to 49% on major trading partners, represents a substantial shift in global trade policy. Markets responded with the S&P falling over 3%, and the 10-year Treasury yields managing to move to approximately 4%. And then this was followed by another drop on Friday. So while tariffs remain complex and often debated topic, their implementation marks an important shift in international commerce. Markets have historically demonstrated resilience through various global challenges, from wars to pandemics and economic transformations. The new measures establish minimum 10% rates with variations based on bilateral trade deficits. For instance, China faces a 34% rate plus an existing 20% duties, while the EU encounters 20% rates. Canada and Mexico maintain previous 25% duties related to specific issues. So additionally, all imported vehicles now face a 25% rate as well. The impact on markets and corporations will unfold gradually. While some domestic producers might benefit, markets generally view trade restrictions cautiously. Companies may need to adjust their operations, similar to 2018 when many firms relocated supply chains in response to previous measures. Sectors with significant international exposure could face the greatest effects. Approximately 30% of S&P 500 company revenues come from overseas, including industries like technology, materials, and staples. These might experience some pretty notable impacts on the cost of their goods. The 2025 earnings season's growth forecast has already been adjusted downward to 11.5% from 14.2%. History also shows that markets can overcome significant obstacles. So as Warren Buffett noted during the 2008 crisis, in the 20th century, the United States endured 2 world wars and other traumatic, expensive military conflicts. The Depression, a dozen or so recessions and financial panics, oil shocks, a flu pandemic or epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. So the bottom line, trade policy and political maneuvering tends to create short-term fluctuation and stir up a lot of fear for investors. What we've been focusing on is reviewing our portfolio holdings and getting a handle on how these new policies might impact them in the long term. As investors, our goal shouldn't be to trade the market, but it should be to understand how current economic environment might impact our holdings and to what degree. If the impact can truly cause a business to become unprofitable, then we might want to worth reevaluating whether or not we should even keep it in the portfolio to begin with. So we also think market declines present opportunities to add into well-run businesses that can grow revenue and earnings. And we also see opportunities with using options for hedging purposes, not speculation, and fixed income. So if you're interested in learning more about how we think about portfolio construction and managing market risks, please reach out. We obviously can't provide broad-based advice on a video here, but we can tailor it to you if you reach out. As a reminder, everything in this video is with information we deem to be credible and is subject to change without notice or update. Nothing said as a recommendation, and we're presenting it for informational purpose. So make sure you do your own research. Here's the disclosure.